Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about one of the most straightforward yet powerful tool in your trading arsenal, the simple moving average. Now, this versatile indicator has been a cornerstone of trading strategies for decades, helping traders identify trends, spot potential entry points, and manage risks effectively. So by the end of this video, you will have a clear understanding on how to harness the power of the simple moving average to enhance your day trading strategy. So let's dive in and explore how you can use the simple moving average to improve your trading results. We start by understanding what the simple moving average is, and this is a widely used technical indicator that calculates the average price of a security over a specified period. Now, this helps smoothen out price fluctuations, making it easier to identify trends and patterns in the market. So the SMA, which is the simple moving average, gives equal weight to all data points within a chosen time frame, provided a clear view of the overall direction of the market. Providing a clear view of the overall direction of the market. So how do the simple moving average work? It is calculated by adding up the closing prices of the security over a certain number of days and is divided by the number of days. For example, if we are making use of a 20 simple moving average, all you need to do is add up the closing price of the past 20 days and you divide it by 20, which is the number of the days you are making use of. This process is repeated for each new trading day, creating a moving average on your chart. You also need to choose the right period when trading with the simple moving average. Your choice of your simple moving average period depends on your trading goals. If you are using, if you are trying to capture short periods or or you are trying to scalp or trade a short-term trade, you can make use of your 5 period simple moving average because this is more sensitive to recent price movement and is used for a short-term trading strategy, while your longer term period, such as your 50 period or your 200 period simple moving average, provides a broader view of the market trend, and they are often used for long-term analysis. Let's not forget that the simple moving average can act as dynamic support and resistance on your chart. When price touches or crosses over this simple moving average region, it can indicate potential trading opportunities. For instance, if price bounce off a long-term simple moving average, this might signal a continuation of a trend. So let's see how we can implement the simple moving average to our day trading strategy. The first step to do this would be to set up your chart for day trading. Setting up your chart, you would need to add your simple moving average to your screen, and because we are making use of this simple moving average for day trading, we would make use of a short-term price movement. That means we will make a setting, we will set it towards the short-term price movement to get more sensitivity to our simple moving average. A common combination we can make use of is the 5 period simple moving average and the 13 period simple moving average. Now, this short period help identify rapid changes in the market direction, which is crucial for your day traders who need to make quick decisions. Your second step would be to identify your crossover signal. When using a crossover of the short-term simple moving average as a trading signal, you would have to wait for when your 5 period moving average, which is your short-term moving average, when it crosses over your 13 period moving average, which is your longer term moving average. In this case, this can signify a buying signal, meaning when this blue line crosses above the yellow line. The blue line is my 5 period moving average, which is a smaller period compared to the 13 period, which is this yellow line. So once the small period moving average crosses above the 13 period moving average, this signals a buying signal. Whereas conversely, when it crosses below, meaning when the 5 period simple moving average crosses below the 13 period moving average, this signals a downtrend. Your third step would be to confirm your trend. To confirm this signal, you can make use of other indicators such as your relative strength index. So if I add my relative strength index to our chart, you would have to see, for a buying signal, you have to see the SMA crossover. Once we see our 5 period moving average has crossed over our 13 period moving average, we would have to look at our RSI to confirm if it's in an overbought region. We'll check the RSI if it's below 70 to ensure that the stocks is not yet overbought. And as you can see at this area where we saw the crossover, it is below 70, meaning that we are still around our area to go to the upside. It is not yet in an overbought region. Remember, the RSI overbought region are above 70, and in this area where we saw our crossover, it wasn't above 70. While in a selling scenario, you would have to make sure that when you see your crossover, you make sure that it is not below 30. So the fourth step would be to manage your risks. When you enter a position after your crossover and when it aligns with your RSI, you make sure you always set your stop loss. For a buy trade, you set your stop loss just below your recent swing low or below your moving average or the resistance region. You just put it at an area that will invalidate your setup when price comes to that area. And your take profit, you can aim for 1:2 or 1:3, a favorable risk to reward to help you capitalize on the market movement. The fifth step is to adapting to the market conditions. In a highly volatile market, you have to consider using even shorter simple moving average, such as your 3 period moving average and your 8 period moving average. This will help you to react quickly to price changes in less volatile conditions, while the longer simple moving average can provide clearer trend on your chart. Your sixth step would be to identify support and resistance areas. Remember, your simple moving average can also act as dynamic support and resistance regions on your market or levels. If price bounce off your simple moving average, your short-term simple moving average, it might indicate a continuation of the trend. So in this case, after our crossover and price is trading above our simple moving average, you can enter the trade the moment price comes back to retest your simple moving average to further confirm your bias before you enter your trade and set your stop loss and your take profit. You can use these levels to adjust your trading strategies and identify potential entry or exit points on the market. The step 7 is to always monitor for fake signals. To avoid fake signals, you have to monitor the strength of the crossover. A strong crossover happens when price move decisively above the simple moving average and is more reliable than a weak crossover, where the price barely touches the simple moving average. Additionally, you can also use your volume indicator to confirm the strength of the trend. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, subscribe, and turn on the notification bell so that you won't miss out on more trading tips and strategies. Thank you for watching. and I will see you in the next video.